Welcome to 3 and 3. Today we're going to be talking about market concentration, specifically the S&P 500, fixed income, the yield curve, and fixed income with duration. So market concentration in the S&P is dominated currently by 10 stocks, and those 10 stocks represent 38% of the S&P market cap. Historically, if you just look back 10 years, it was about 17%. What that means is there's more risk in the index because we have less diversification. Looking at NVIDIA, it's about 8% of the market cap index of the S&P, Microsoft at about 7%, Apple at about 6%, and Amazon and Alphabet at about 4%. So going back again to 2015 at 17.17%, in 2020 at about 29%, and currently at again about 38%. So fixed income and yield curve. The yield curve is a graph showing bond yields, and those are interest rates across different maturities. The x-axis represents time to maturity, and the y-axis represents yield. So there are variations in this actual yield curve. So a normal curve would be an upward sloping curve, where long-term bonds pay more interest rates than short-term bonds, and that means we're expecting some growth. An inverted yield curve would be downward sloping. Again, short-term rates would pay higher interest than long-term rates, and we're expecting some form of recession potentially or slowdown. And a flat curve represents some market uncertainty. So how can investors use this? Again, it helps investors gauge this interest rate move based upon what's happening with inflation and growth. And it guides duration strategy. Do we want short or long-term actual bonds? It helps anticipate where we're at in the economic cycle. Is there going to be growth or are we expecting a slowdown? And it informs us of risk management. Do we want to have interest rate risk or do we want to have credit risk? Do we want to have high-grade bonds? Do we want to have low-grade bonds? And also do we have short-term bonds or long-term bonds? And it's definitely used in portfolio construction to balance yield versus safety. So as you look at this chart, you're looking at the yellow chart is the current curve in 2025. And it is upward sloping after you get past the first part of the actual curve. And there's a slight dip because we're expecting the Fed to lower rates by 0.25% or up to 0.75% over the next year. The 1 month to 2 year segment typically represents, again, the Fed's policy. And it is currently right now between 3.7% and 4.5%. The 10 to 30 year segment is the longer term bonds, and that reflects inflation and fiscal pressures. That's currently at 4.3 to 4.9%. If we compare that to the 5-year yield, you can see that yields are significantly higher across all maturities. The investor implication, again, is a normal slope suggests, again, stability of inflation and growth, and the spread between short-term and long-term maturities is something to monitor for risk. So fixed income and duration. So duration measures a bond sensitivity to interest rate changes expressed in years. A core measure of interest rate risk in fixed income is duration. The longer duration is going to have more volatility, and the short duration is going to have less sensitivity to these rate changes. The rule of thumb is that if interest rates rise by 1%, bond prices fall by 1%, and vice versa. And the investor implication, again, is it helps us match portfolio risk with our interest rate outlook. It guides asset liability management for pension insurance companies and is used to compare bonds with different maturities. So as you look at this chart, you can see the bond price sensitivity of a 5-year duration. An example that if rates go up a quarter or up to 1%, the bond's going to fall up to 5% and vice versa. Thank you for joining us for 3 and 3.